Oh, hello everybody again. It's Randy Nordby. Today we are going to talk about a case study in portfolio management and risk management. Now this section is focused on institutional investors. Now, as you may have guessed, we also have one for private wealth. What is so nice about these cases is that these are extremely detailed situations that describe a very real practitioner-based experience if you go work with institutional clients. So this case study is going to bring up a number of issues and a number of topics. But one thing I want to caution you on, going through this case study is not enough. There are supporting questions in the Kaplan material and the CFA Institute material that help you take more information and really process this information. So think of what we're going to be doing right now as kind of a 30,000-foot overview of an extremely detailed case study on institutional investors. So we'll have a couple clients. It's going to dig into it, go through the whole process to help you be better prepared to deal with more complicated and more real-world issues when you get ready for the exam. Okay, so I love this new case study in institutional and portfolio management. So again, I want to caution you, it is not enough to just listen to this lecture. You need to actually work the quizzes that accompany this section in the Kaplan material. And I also want you to look at the questions in the CFA Institute source material. Okay, so again, private wealth management and institutional wealth management are going to determine if you're going to get your charter this year or next year. Let's make it this year. Okay, so let's dive in and let's experience a real institutional portfolio case management. Okay, so here's what I want you to think about. As we go into the exam, this case study really draws out issues that if you worked a ton of institutional portfolio manager questions, you would start coming up with these analyses. You'd come up with these processes, these questions that seem to be very likely or areas of interest that the exams tend to focus on. So what are we going to specifically cover in this case study today? So we're going to talk about how to capture this illiquidity premium. We're going to talk about how to manage liquidity. We're going to get into asset allocation. We're going to talk about using derivatives or cash for tactical asset allocation. And then we're going to get into portfolio rebalancing. So we're covering a lot of topics today. Now, we can't talk about case studies without talking about ethics. So as you go through these cases, start thinking about some of the possible ethical violations that occur during this information session as we're talking about this institutional client. The other thing I have to warn you is that some of this material is actually covered in other areas. So this is more of a capstone. Both the institutional and the private wealth case study, I would use them as actually capstones. So this is going to cover and synthesize prior knowledge that you've learned in other topics, specifically alternative investments. But there are a lot of topics here that are covered in other areas in much more detail. We're just giving you an overview and helping you to identify some of these key areas. Okay, so managing liquidity risk. Well, first of all, I would like you to understand and be able to define what is liquidity risk. Hey, if they happen to ask it on the exam, here's a couple quick points. And notice it's not a 5-page definition, it's a few words. So what does the curriculum define as liquidity risk? It's disposing of an illiquid security at a discount, okay, during periods of market turmoil. Now, there are 4 key methods that we're going to teach you to manage liquidity risk. Okay, so the first one, we're going to get into liquidity profiling, and we're going to develop what's called a time to cash table that really helps you visually understand what your portfolio looks like. Another issue that we have to deal with liquidity. What about rebalancing and commitments? Those are things that have to be done. Stress testing. And when you think of stress testing, I want you to think of Monte Carlo simulation. And again, the CFA Institute loves Monte Carlo simulation, and Monte Carlo simulation permeates really the whole literature. Okay, and then the other area that we're dealing with managing liquidity risk, we can use derivatives to deal with a lot of those issues as well. Okay, so let's talk about this liquidity profiling, and then let's get into these time to cash tables. So first thing that we have to understand with any client, not just an institutional client, we need to understand the cash inflows and the cash outflows. And we're going to have to do some work here to have a reasonable estimate. Okay, so for a university endowment with sizable holdings of illiquid assets, the portfolio manager is going to have to estimate cash outflows to the university to pay, whatever it is they're supporting the university for, and they're going to have to estimate capital call request for certain types of their holdings, because we learned in that section they tend to have a huge concentration in alternative investments. So any type of capital call request that follow hedge funds or private equity, we're going to have to factor that in. They become liquidity issues. Okay, now the other thing that's important to think about, if we're dealing with a university endowment, I want to think about cash inflows. Because what happens is if I have money coming in, I don't need to spend so much from the portfolio. And then we'll also take a look at any investment income that are earned from those portfolios. So it all starts with estimating your cash inflows and outflows. Okay, the next step is you're going to build a timeline, and you're going to construct this what we call time to cash table. These are very useful, and I want you to also understand how to read them. This is likely how you will see. You're not going to likely have to create it, but most likely you're going to have to analyze it. Okay, so we're going to go over some of these in a few minutes. So here's what a time to cash table, or if we wanted to get into this idea of liquidity profiling, what are the distinct components? I want to know simply how much time is needed if I have to sell this asset when I can turn it into cash. Then I want to identify liquidity classification level. And then finally, I want to create a liquidity budget. So again, I'm just trying to get an understanding in my portfolio, what does it look like? And then I want to compare that to my estimated inflows and outflows and make sure that I'm where I need to be in regards to liquidity. So let's take a look at this time to cash table. First thing I want to draw your attention to, time to cash. Okay, we have it broken out here. We see less than weekly, less than 1 quarter, less than 1 year, greater than 1 year. Now, does it have to be this way? No. Maybe you do it semi-annually, or maybe you do it every 5 years, or maybe you do it every few days if liquidity is a huge issue. But this is a reasonable amount to bracket and gather information here. Let's get into this liquidity classification. So less than 1 week, I agree. I would call that highly liquid. If it's less than a quarter, time to cash, I would say that's liquid. We're going to define less than 1 year as semi-liquid. And if it takes more than a year, it is illiquid. Okay, so we've defined the time to cash. We've defined our liquidity classification. Now we have to figure out our liquidity budget. Okay, and this is going to be as a percentage of the portfolio. That's the best way to present this material, and it just makes it easier to use as a fund manager and for everyone to be clear. So guess what? Time to cash is less than 1 week, so we're going to make at least 5% of that portfolio. So notice that's a minimum. I want to keep at least 5% of the portfolio in cash, in an asset that I can convert in less than 1 week to cash. Highly liquid. Same thing, we see a quarter. Let's keep at least 25. For less than 1 year, let's keep it less 40%. So again, we have minimums. And then for our illiquid investments, we're actually going to have a maximum. Okay, so just looking at this time to cash table, this gives me a lot of useful information that I'm going to need in order to deal with the liquidity challenges of running this fund or this investment. Okay, so the other thing I want you to think about, and we talked about this a little bit, is, and you just saw it here in this picture, this liquidity classification. We want to basically link the amount of time it takes to liquidate that investment, again, without having a major impact on the market. Now, the other thing that seems pretty clear to me, and hopefully it will be to you, is that if it takes over a year to actually convert this asset to cash, we're going to consider that illiquid. In order for us to properly analyze the case and to score the most points on the exam, we have to be comfortable with the definitions. That's what we're trying to provide you some guidance here. So guess what? If I see the wording illiquid investment, I'm thinking, okay, it's going to take a year or more in time to cash. Okay, so that's how I want you to approach it. So this time to cash may include a full range of periods beyond those 4 periods that I just showed you. So we're going to model this off of the investor's cash outflows. So I want to see when these requirements are, and then I'll build that time to cash table to actually incorporate that. Okay, liquidity budget. We saw as percent of portfolio, it provides a minimum for liquid investments and a maximum for illiquid investments. And again, break it down as percent allocation of the portfolio in each time period. I think it's very useful that way and very helpful. Okay, so again, we showed the 3 more liquid groups as minimum. We showed the illiquid group as a maximum. The other thing that I want to see, I'd like to see some results from the stress test, because what this is going to do is help me determine the required liquidity budget that I need in order to satisfy my obligations in all market situations. I think if you go back to the period of 2007 to 2009, we had one of the best stress tests we could ever run. Unfortunately, it really happened. Okay, so stress tests are extremely important, and they don't have to be just historical. You can move the numbers around and really stress that portfolio, and there are mathematical techniques where we can stress the portfolio even more to see what happens. Okay, so developing this liquidity budget, it's going to begin by reviewing the liquidity traits of your investments over a reasonable time period. So within specific asset classes, every investment basically has different specifications. So various investments could have very diverse liquidity characteristics, maybe like an ETF. And then at the same time, that same type of investment could offer different levels of liquidity as well, like a commingled fund. Okay, so when we look at the liquidity profile, let's take a look at this. So we've developed one in this case. So we've got asset classes. I see really a few here. We have fixed income and we have domestic equity. So fixed income is 12% of the portfolio. 20% of the portfolio is domestic equity. But then we're actually breaking it down in a more granular level. I want to see what investment vehicles, what securities am I actually doing in order to get this allocation. And we see we have a separate account. So that's 4% of the fixed income portfolio. The liquidity classification, it's 100% highly liquid. Now then we take a look, we have 6% of that 12% actually in a commingled fund that is also highly liquid. And then finally 2% of that 12% fixed income allocation is in a futures contract where again, it is 100% of that 2% is highly liquid. Okay, so that's what's so important to go through these asset classes, go through the asset class allocation, look at the percentage of the portfolio, and then take a look at the investment allocation, and then go down even one more level and look at the investment vehicle, and then use your liquidity classification, link it to that investment vehicle. And we can do the same thing here for domestic equity also. Okay, so rebalancing. Unfortunately, managing liquidity is not going to be enough. It is going to be critical to maintain the portfolio's risk profile. And we're going to have some quantitative range, that we want to keep here. Okay, so over time and during market stress, asset values are going to change. That's a given. We know that. So what do we know when we're thinking about rebalancing costs? Unfortunately, rebalancing illiquid assets is very expensive. So it's going to be critical to maintain enough liquid assets to execute this rebalancing transaction. Okay, because you might not be able to sell that particular liquid investment fairly quickly, but you're still going to have to make rebalancing moves with the portfolio. And we're going to talk about techniques that you can do that. So we're still staying at kind of the 30,000 foot level. Okay, there are systematic rebalancing policies. That's one way to handle rebalancing. So we're going to design these in our long-term strategic asset allocation. Now, the Institute has talked about two prominent ways that we can use systematic rebalancing. So one way is calendar. Hey, every January 1st we meet. This is evil. I don't want you to do this. The CFA Institute doesn't want you to use this method. They recommend that you use this percentage range rebalancing with acceptable ranges for each asset class. Okay, so what does this mean? So narrow ranges incur frequent transaction cost. So each time that allocation percentage falls outside its narrow range, it hits, and then you've got to rebalance it. So what's going to happen? Well, you know what? You can use wider ranges for more volatile assets. That way they won't keep hitting that rebalance threshold and then having to do something with them. So we can use wider ranges for more volatile assets. One thing I want to caution you though, if it's an extremely volatile asset, you might want to think about also narrowing the range. Now it sounds counterintuitive, but here's why. If it's an extremely volatile asset, if you narrow that range, you can keep a closer eye on that particular investment before it gets too far away from you. So yes, we can use wider ranges for more volatile assets, but I just want to put a caveat. It's possible we may want to think about a narrower range for an extremely volatile asset, just simply so we can keep a better eye on it and it helps us better with risk management. Okay, so automatic adjustment mechanisms. So what are these doing? Well, they're going to assist the portfolio manager and keeping the portfolio's risk profile relatively constant. So here's an automatic adjustment. Let's say your portfolio is exposed to market risk relating to private companies and public companies, and that we use public companies as a proxy for private firms. So basically, this stock PE has a beta of 1, and the PE allocation, let's say, falls 2% relative to the target. So automatic adjustment is going to increase the public equity allocation by 2%. So what just happened? It maintains the level of systematic risk. Okay, so we can also think of it, this unsystematic risk has decreased because this automatic adjustment happened. And this, again, is a tool portfolio managers can use to help them keep the portfolio in line with the risk targets. Okay, commitments. We've talked about this, and we'll talk about it more in alternative investments. But unfortunately, private equity funds, they make it more difficult for the portfolio to keep stable or specific allocation levels in the long term because of this timing and frequency of capital committing and capital drawn. Now, those are beyond the control of the portfolio manager. We don't know when this is going to happen, so it does make it a little bit more challenging. How can we handle that issue? Well, just invest in multiple private equity funds. Then we get more stability and more stability in our frequency distributions. So again, another good idea to diversify. Okay, now we could have a multi-year funding strategy that's going to try to determine the optimal level of annual commitments from that portfolio. And the way we typically deal with this is we'll set a long-term exposure to that asset class. Hey, I want to keep 15% in this private equity space. So we can also use extensive quantitative analysis. I can estimate this rate of committed capital draws and the rate of change as asset sizes change. So bottom line, we can determine asset class exposure, and it is going to be needed for several hypothetical commitments. So I can't stress this enough. This is a pretty intensive quantitative analysis, and this is also a great place for Monte Carlo simulation. Okay, stress testing. This is going to consider changes in the portfolio during periods of market stress. And again, 2007 to 2009 is a great real historical model that you can use to shock your particular model and see what happens to your portfolio. So we're going to assume worst case or very extreme market conditions, and we want to know the impact on both the assets and the liabilities at the same time. So again, we can base it on history. We can use some statistical model. We can also use some form of scenario analysis to even shock the portfolio more. Okay, derivatives. The reason I use derivatives as a portfolio manager, and the reason many people do, it requires far less cash than investing in the underlying asset. If I need to rebalance the portfolio, yes, I could buy an ETF if it's, let's say, the Russell 2000. But maybe I'd rather use my cash for something else, and I can use a derivative and use that extra money that I didn't have to put in to hold that position into another area. So these future overlays or derivative overlays, they allow for rebalancing of many. But let's stop for a second. Not all asset classes have active derivative markets. So that's part of the risk that you've got to take as a portfolio manager. You have to be aware of which markets you can use the derivatives overlay and which one you can't. Okay, so with leverage though in derivatives, that long futures position only requires minimum cash for that margin. So again, cash not required for that margin can be used to invest in other assets or to meet other liquidity requirements or goals. And options. Options can be purchased at premiums that are generally a fraction of that underlying asset. And they can also be sold and are frequently sold to earn premium income, again, that generates liquidity. Okay, so let's look at two classifications of alternative investments that absolutely meet the definition of illiquid investments. Private equity and private real estate. So they're going to earn additional return over in excess of the market return for basically tying up this capital. We call that the illiquidity or liquidity premium. Now, this is what you need to know. Academic studies have shown that this illiquidity premium increases with the amount of time. Think of an upward sloping yield curve, for example. An alternative way to model this illiquidity premium, we can use the value of a put option. And what is the strike? It's going to be the theoretical estimated price, pretending that this illiquid asset could be freely traded. Okay, so this leads to basically the computation of an illiquid asset with this general formula. Please write this down. I think this would be a very helpful formula for you to have in your back pocket. So an illiquid asset price is going to equal the marketable asset price minus the put price. Okay, so this is a good ballpark, a general rule for coming up with a quick estimate on a liquid asset price. Okay, so using that marketable asset, remember we just estimated that, and the liquidity prices, we can actually derive expected returns. And we're going to say that it's going to be the difference in expected returns would be this illiquidity premium in percentage terms. So this is another general formula that I think would be extremely helpful. So we can say your illiquidity premium percent is going to be your expected return on the illiquid asset percent minus the expected return on that marketable asset that you theorized. So again, another key point. There are numerous studies to support positive correlation between illiquidity and the expected returns for publicly traded stocks.